Market's trying to bounce back after yesterday's shock to the system. Russell 2000 futures up about 1.5% almost after getting shredded yesterday. Bonds and the dollar pretty quiet. Let's talk some more about what we learned and how it changes the plans for the Fed. Milton Ezrati is the chief economist at Vested. Milton, thanks for being here this morning.
Pleasure to be here.
Appreciate that. Yesterday was a pretty fun session. Got some action in the market as we responded to a pretty warm inflation print. What'd you make of the data yesterday? Let's start there.
I think there was never a chance that the Fed was going to cut rates as fast as the market expected. And the inflation numbers brought home that fact, and the market gave up the hope that they'd have rate relief anytime soon.
Okay.
Great drama.
Oh, yeah. How do we define that, anytime soon? Because it seems like the market was convinced it was going to be, a win situation, not an if. Is that shifting a little bit?
And I think the Fed was telling the market all along that even if they got good inflation numbers, they wanted to make sure that that this inflation was not going to get away from them. The Fed was well aware that in the past they had reacted too fast, released some of the pressure when inflation showed a modest improvement, and things screwed up. So Powell was very definite. He said, we will keep the rates high even after we've gotten the inflation where we want it to be, and it ain't where it is yet. Then they got numbers that the inflation may not be as tame as people had thought. It was a big disappointment. I think the market, in a classic Wall Street mistake, had mixed its expectations up with its hopes, and it was hoping for immediate rate relief. The Fed had told them they weren't going to get it, and they didn't. And then now they know they're not going to get it.
Where do you think the power in the economy is coming from? The continued surprising strength before yesterday's inflation beat, pretty much everything's been surprising to the upside.
It has. We've gotten very good GDP numbers. We've gotten good jobs numbers. There's some skepticism about that, but that's another story. It's all the consumer. That's who it is. We've seen some increase in capital spending. The government, local governments are spending a little more. The federal government is spending a little less than was forecast, which is good, I suppose. But it's really the consumer that's driving the economy, and he and she are going into debt to do it, which is another reason the market may be a little wary here.
The consumer, even with the heavy debt loads they've got, still got the jobs. Seen employment hold up pretty well. Do you see any obvious imminent cracks in the economy right now?
The cracks I see are, I'm concerned about the consumer. The debt's there. What the Fed reported recently, that delinquencies have begun to rise. And that doesn't mean that people are failing or they're going bankrupt, but it does mean that they're late on their credit cards, which is really what the bulk of it is. And it means they're getting a little stretched. So my attitude is the consumer is not going to turn off because, as you point out, they have the jobs, and it's that the consumer may slow down. And with nothing else or very little else, certainly housing is not helping the economy. With very little else in the economy, we're going to see some slowdown. That might make the market feel good about rates, but the Fed, I think, has been pretty firm. I don't think we'll see anything from the Fed until late in the year, if then.
There's still this lingering assumption by many economists that we've got lagged effects waiting to break us down from the hiking cycle. I wonder if some of that's been misplaced when we come off the zero bound. Maybe there's not a lot of growth to be found down there. Is it possible that maybe coming off that zero bound, spurring some companies to shift buybacks into CapEx? Is there any reason to believe that maybe some of this was kind of stimulative at first?
It might have been, and I think even in housing, the inflation scared people. They wanted the mortgage at lower rates. They wanted the house. It was the ultimate hedge against inflation. So I think there was some of that. I don't know if that's enough to do it if the consumer slows down.
That's a great point too. With kind of that housing rush, right? You think rates are going to go up. Fed says they're going to start hiking. Boom. everybody comes off the sidelines, bought a bunch of houses. It's a really good point. Wrote about it this morning, but forgot the housing part, so that's a good addition. I'm thinking about what to look for then next. I mean, how do we kind of get the read on the month-to-month marginal shift in the economy? Do we have to wait until it shows up in unemployment? Will that tell us? I mean, we've had these regional bank scares, but they've seemed to be contained.
Well, I think I don't think we're going to have to wait for unemployment because it tends to lag things. We'll see it in some of the month-to-month numbers. The consumer, the retail sales are important. The consumer spending numbers. I'm watching the debt very carefully. If the consumer starts getting frightened and says, "I got to pay down debt or slow down," then the economy starts to falter. That might mean something good for the Fed some months down the road in terms of rates. But in the meantime, people start worrying about profits.
When we see earnings lift stock prices like this, does that help the situation by the wealth effect, or does it hurt the situation as the Fed, maybe feels they're not being restrictive, they can keep rates higher?
Well, that might. It's a different cohort in the economy that's going to win with the on one side and another loses on the other. So I think that we're going to have. I think the economy's slowing. It's going to slow. It has to, because the consumer can't keep up the pace he and she is spending at. That doesn't mean they're going to turn it into a recession, but it does mean they're going to pull back. And I think that the market's going to be following that, and that's going to hit the profits ultimately. I've noticed that margins have begun to shrink, which means that companies are having trouble keeping up with costs. And that, I think, is going to show up increasingly in coming months and quarters.
Okay. Speaking of coming months and quarters, the last kind of thing on the list here is elections at the end of this year. I mean, the last time we had elections around COVID, it was like each guy was trying to out-promise the other on how much stimulus they're going to drop on the economy. What should we be thinking about for that subject?
Well, they're starting that. Trump has started to talk more about spending. No one is talking about entitlements. And we have a budget problem, and there is absolutely no one in power talking about remedies for that. And as the election approaches, we're going to see promises on the other side, just as you point out. There's going to be a lot of that. I'm not so sure, ultimately, being that people are going to buy this, because they know the last time they did this, we had inflation. And I don't think the consumer's memory is that short.
Okay, so maybe it won't be as easy as a sell this time with inflation still sticking around. Good stuff like the thought process. Thanks for helping us figure it out, Milton. Appreciate your time.
Thank you. Take care.
Absolutely, yes, sir. Milton Ezrati, Chief Economist at Vested.